Greetings, everyone. My name is Talente Mgomezulu. I'm an accounting as well as math and economics tutor. So today we're going to be looking at accounting grade 12, and we are going to be looking at the most interesting and most funny as well as nice topic, which is tangible assets. So let us go. All right. Suppose this is the information given to you. We are giving a fixed asset note. Then this note here is written that you need to calculate uh, this missing figures, which is Roman figure 1, Roman figure 2, as well as Roman figure 3. So now you need to calculate them, and so that you can able to grab some marks. So it is an interesting as well as a very fantastic topic I've discovered, and I like tangible assets very much. Even here in university, in financial accounting, I'm still interested in financial assets. Because it is the nicest a topic to deal with. So now let us look how now to solve this problem altogether. Okay, without the waste of time, of course. So now, what do you need? Firstly, we need the accounting period. Unfortunately, this is just the extract taken from a past paper. So there was a name of a company, as well as the accounting period. So I didn't have an accounting period, but the accounting period, it is of course as written here as 28 February 2022. So the first thing that you need to able to acknowledge when you are dealing with this is the accounting period. So the accounting period is just, it ends on the 28th, okay, 28 February 2000 right 22. So it says 2022. So if now you have the accounting period ending, I suggest that you need to also have the accounting opening, the accounting period in the beginning. So the accounting period in the beginning is just one. If it ended on February, that means it started on 1 March. So it's 1 March 2021. Right. So this is our accounting period. So now let us simply do the calculations. So they say now here we can see our first Roman figure is just standing here in a carrying value. We can see that in a carrying value. How do we calculate a carrying value? So carrying value is nothing but it is equals to the cost minus accumulated depreciation. So for us to get a carrying value, we must take the cost and subtract the accumulated depreciation. It is for us to able to get a the carrying value. So we say that for calculating carrying value strategy, the carrying value, it is an initial cost of an asset minus accumulated depreciation. Okay, so it means that our cost for year is given is 2 million, sorry, is 2,350,000. It's 2,350,000. Okay. Then we subtract 840, which is the accumulated depreciation. It is there, is indicated with the bracket sign. So we subtract 840,000 minus 840,000. So thereby we get the answer. So we say 2 million, taking your calculator, I'm using my Casio calculator here, 2,350,000. Okay, 2,350,000 minus 840,000. It gives me nothing but 1,510,000. Gives me 1,510,000. Okay, now that is a final solution. Sorry, that is a final answer for Roman figure 1. Calculating is the simplest. You can just grab these marks. It's a very, very simple one. It's a cake, it's a piece of cake. You can just have a bite on it. So let us follow another figure. So figure number 2 is asking us to get a depreciation. So when getting a depreciation, this is what you need to know so that you will always be good in depreciation. So now you are being asked to get a depreciation, right? A depreciation. This is a strategy that you need to know about a depreciation. So for you as a student to get a depreciation, number 1, you need a cost. Number 2, you need a method, because it's very important. A method. A method. You need a cost, you need a method. And once you get the method, there are 2 kinds of method. We have a method that is called straight line method. We have a method that is called a book value or a diminishing method. So if you are using a straight line method, for example, let us say you are just using a straight line. Okay, methods. Only what you need just a cost, right, times a depreciation percentage. The depreciation percentage is always per annum. That's why you need to times with a months, excuse my spelling, divided by 12. That is a strategy that you need. So if you are using a diminishing, thing changes, a diminishing, right? Let me just say a book value or diminishing method. It's a diminishing or a book value method or a reduction method. Say it's a reduction method. What do you need in order for you to survive? So here we just need a cost of a vehicle or of an asset, whatsoever asset, it's not always a vehicle, minus accumulated depreciation. Accumulated depreciation, sorry, excuse my writing. My pen has been stacking. Accumulated depreciation. And after that, we will get a carrying value. Then take the carrying value, also multiply the carrying value with the depreciation percentage. After that, then times it by month. All right, it's similar now for when it comes to excuse my my writings, months. Okay, just the period of months over 12. Okay. This is a strategy that we need to use when doing all this stuff. So you must be equipped to this because it's practical strategy that you must use. Right? Okay. So now let us come here and look what we've been given here. So here we under equipment. Then there are three kinds of depreciation that you must able to calculate, and there is that one that I always call it is a required. Judging on the past papers that have been analyzing, there is no way you can come across having a new introduced assets. Sometimes we work with assets that are already in the business, but do not take that maybe as I'm making a disclaimer. It is not always the case, but I've never seen it. So always, this why by this one, I'm trying to say, calculating a depreciation will always require you to calculate old and remaining. Old and remaining is a first depreciation that you need to calculate. When they're saying calculate depreciation, they are meaning you must able in your summation or in your totalings of your depreciation, you must have what is so-called remaining or old. All right. So now let us say we must have old. Then you go to your transactions. In your transactions, you will be told whether there is a disposal, the sale of an asset, or there is an introduction or the buying, the entrance of a new equipment. So let us just look in our transaction. They say additional equipment was purchased. Additional equipment was purchased. So because they are saying additional, so you know that for equipment we will also have new. Okay, we'll be also having new. I always recommend people to just start with new because new will always be simple. New, all right. Then again, let us apply this thing of us. We need the cost. We need the cost of new. We also need a strategy, an equipment, a method, and we have a method which is 10%, and we have told that it was purchased on what date because we'll use that for months. So now we yet do not know that I'm interested in. We yet do not know about a new equipment. We were not told about new equipment value is of a new equipment, but you can get here, and here there is an addition. This addition tells us the number or tell us the amount of introduced new assets in the business. So now, simple, straightforward, our new equipment is just 195,000. All right. So we just say, oh, okay, we have just 195,000 is our cost. And method is 10% on cost. Simple. We just come here and say, oh, we will times by 10%. And we will get 19,500. But 19,500 is for 12 months. So 19,500 is equivalent to 12 months. Actually, But this equipment is new. Let us see. According to the information, it was purchased on 1 October. So it wasn't there on 1 March. It wasn't there on May. It wasn't there on April. It wasn't there on June. It wasn't there on July. It wasn't there on August. It wasn't there on September. It just popped up in October. All right. So now, what does that mean, or what does that tell us? It tells us that we will use the month that this equipment take inside or occupied inside the business. The date which this equipment was already to be used. So those period or those time, those duration where it was used, it is a period that we need. It's called the prorata. It is called the period of which it was already being used in the company. So let us calculate. How to calculate it is October, because it started on 1 October. So it stays October, November, December, January, February. Then the accounting period ends in February. So it stays 5 months out of 12. So now we say 19,500 times 5 divided by 12, and we get 8,125. 8,125. So now we are done with the new. Let us go back to old. Right? Okay. Now, old. In order for us to able to calculate the old depreciation, I used to tell my students this, that whenever you are being told to calculate a depreciation, then you're about to calculate a depreciation for old vehicles or old equipment or furniture, you must do something. Is very important. I'm putting the exclamation marks here. Inspection. Inspection. What is an inspection? What are we trying to inspect? Inspection. So in an inspection, simple and straightforward, in an inspection, what are we trying to look for? In an inspection, we know that the carrying value of the vehicle, of the asset, or of whatsoever asset in the business shall not be equals to 0. Or to say it, or in other terms, let me just put it like that one. The carrying value must always be greater or equals to 1. That is the case. The carrying value of an old equipment that is still being used or that is still in the premises of the company must be greater or equals to 1. Now, let us check. In this aspect, we are giving the equipment, it's already be greater or equals to 1. But I'm worried about the new depreciation to be calculated, because if I'm having 28, then the depreciation is calculated on cost. It means that I'm having 884,000, and 84,000 is greater than 28. But let us do it so that you can see. So we know that to calculate a depreciation, we just use this format. Straight line is cost times a depreciation percentage. So the cost of a new vehicle, of an old vehicle, sorry, is just 840,000. So let me calculate the depreciation here. Okay. It will be 640,000, sorry, times the depreciation percentage, 10%, times 10% is also similar with saying 0.1 or 10 over 100. So don't be mistaken. Maybe if you are using any calculator rather than Casio that does not have a percentage sign, you can just say 0.1 or you can just say 10 over 100. It's up to you which one you use, but any of them will be correct. So now let us move forward, and we need the months. We know that old was there in 1 January, March, and it is there evenly in February. So it stays 20, 12 at 12, 12, sorry, 12 at 12, 12. So there's no need to write this one because 12 at 12, 12 is equal to 1, but just write it for the point that you don't get confused. You follow the strategy carefully. You are being consistent, and it is what I would like. So we will get 64 here. Press your calculator, we'll get 64. Okay, now let us look at a new carrying value. A new carrying value that we may have will be 28,000. Okay, someone is asking me, where do that 28 come from? Is here on the beginning of our accounting period. So we will take this 28,000 and we subtract 64. Automatically, we are having a depreciation. We are having a carrying value equals to 28,000 minus 64,000 minus 36,000. We are having a depreciation that is minus a carrying value, sorry, that is minus 36,000. The inspection, however, says it is compulsory that the carrying value must be greater or equals to 1. So, what does that mean? This tells us that we are rejecting this depreciation. Howsoever, why do we reject this depreciation? It's because this depreciation will give us a carrying value that is less than 1, which is negative 36. So, therefore, we will then say a new depreciation to be approved, or a depreciation to be approved due to this method is to take the carrying value, the opening carrying value, and subtract 1. Right. So we will take the carrying value, and subtract 1. So you can get that depreciation. So therefore, we'll say the depreciation is 28,000 less 1. So the depreciation is simple. 28,000 minus 1. The depreciation is simple. Is 27,999. So that one is our new depreciation. Okay. So therefore, the total depreciation for Roman figure 2 is a summation of these two depreciation, which is 27,999 plus 8,000. Okay. 125. Okay. Plus 81,000. Oh, 8,000, sorry, 125. And which is 36,124. 36,124. Okay, voila, we are done. Let us move forward. Now they say calculate the disposal at a carrying value. So a disposal at a carrying value is also simple. It is just, okay, let me just add another new slide here. So now we want a disposal at a carrying value. So a disposal at a carrying value is simple. It's just the cost minus accumulated depreciation at the beginning minus new depreciation or current depreciation. I call it current depreciation. So if you want to definitely get a carrying value, then it will give you a disposal at a carrying value. So now let us check what is that we are giving. Right. Sorry. So okay, sorry again. We are being told here that a vehicle, an old vehicle was sold at a carrying value on 30 October 2021. The date is very important. We will use the date for the calculation of the depreciation. And the cost price it was, and then we have the cost price. Something very good. Accumulated depreciation on 1 March is 120, is 172,000. Then the depreciation just use per annum, 20 cost per annum. So let us just write what do we have. We have a cost of 252,000 cost. We have the cost. Cost is just the cost. Sorry. Cost is 200. It's 252,000. 200 and excuse my writing. 252,000. And we have the accumulated depreciation in the beginning in the 1 March, which is just 172,000 minus 172,000 minus what is remaining is a current depreciation. So let us look for current depreciation. So we know that to calculate the depreciation is very simple. We need the cost. We have the cost. The cost is 252,000 minus the accumulated depreciation. Why I'm saying so is because we are using a carrying value method, and a carrying value method is a book value method. Is we need to get the carrying value. So 172,000, which is equals to 252,000, sorry, minus 172,000, which gave me 80,000. Which gave me 80,000. Then I'm timesing it by the depreciation percentage. Okay, depreciation percentage is 20%. I'm timesing by 20%. Sorry, excuse my writing. 20%, which is 0.2, or which is 20 over 100. And I'm timesing it by, because I know that the depreciation I will get here. Okay, let us follow the strategy carefully. If I do this thing, I would definitely get 20,000. 20,000. Okay, sorry, I'll not get 20,000. I'll get 40,000. Sorry about that. Yes, I'll get 40,000. So it's 4,000. Sorry, 4,000. So let us check whether I'm correct or not. 80,000 times 20%. Okay, incorrect. I thought that I'm a genius because I thought that I'm a genius. So it's just 16,000. Sorry for that mistake. I am just combining these activities with those that I'm doing in the class. So I remember there was similar of this one. So it's 16,000. Okay, yeah, 16,000. Sorry about that, but hopefully you're fine. I trust you. 16,000. Then after 16,000 is just for 12 months, but this assets or this vehicle, it didn't stay up until November. up until February. It just stayed up until November. December, January, February, it are not in the accounting period. Only 9 months the vehicle was still in the premises of the company. 9 months. So I'm accounting this for 9 months, not for 12. Instead of 12, I'm accounting 9 months. So times 9 over 12. And I'm having 12,000. So 16,000 again times 9 over 12, giving us 12,000. Right? Thereby, I'm substituting 12,000 back to track here. Then this is what I got. So it's 252,000 minus 172,000 minus 12,000. So it was sold at a cash price or at a carrying value of 68,000. And that one is my final answer. Okay, so I'm done. Thank you very much with your time. See you on the next video.